Welcome, ladies and gentlemen. This is Brad Matheny. Today is November 19th, still early in the morning, working away on my weekend update. I'm getting ready for a nice holiday with my family in beautiful Southern California, where it's still moderately warm, and at least where I'm at, there's not an inch of snow on the ground. Thank goodness. Okay, so here's where we're at this week. I've been going over everything, trying to highlight where we're at, and it really comes down to the fact that we are in a consolidation phase with regards to the global markets, and we are trending sideways. This is the consumer index, my custom consumer index. Consumers are still fairly cautious. You can see this is the November bar updated just yesterday. Consumers are still cautious, slightly pulling away from expectations. This is related to the Fed and what we're expecting going forward. We are off of this bottom. We are seeing upward trending somewhat. We do need to see consumers rebound a bit. So that's kind of where I expect the markets to go. Move up into a sideways melt up through Thanksgiving and through the end of November, then potentially consolidate into a bit of a sideways mode. So I would hypothetically expect this consumer index to move back up into this 30% range, kind of flattening out through November 7th, 8th, 9th, or sorry, December 7th, 8th, 9th, and 10th, possibly moving into an upward melt up near the end of the year, which could put us back up into this level by the end of the year, attempting to move up into a breakout in Q1 2023 and Q2. Now, we have the cash flow index is showing that buyers are coming back into the market after the bottom. This is a weekly chart. So about 7-8 weeks ago, buyers were coming in and starting to accumulate this bottom, very similar to the COVID bottom. We're kind of in this area right now, if I were to guess, where we're going to see a consolidation through Thanksgiving and early December, and starting to move into more of a solid melt up after the 7th, 8th, 9th of December. That would put us possibly reverting back up into this area here with regards to a melt up, maybe a little bit lower, maybe down into this area. The overall consensus for the market is that fear is weakening. We are starting to see this fear index move downward. We're below the topping pattern here. You can see this dashed line here. We're down into the January, December, January peaking early fear levels, and if this continues to move downward, then we're going to start to see some real momentum building, some possible capitulation to the upside. So where we're at with our trading system, our momentum reversal system, our rotational modeling system, I don't know why I call it the momentum reversal system, but anyway, long and short of it is weekly SPY, we are still bullish with 25% allocation. We've got 24.02% net in that position. Daily, we are bearish, still bearish. I'm going to show you a chart here in a minute. We're getting very early sign topping patterns, which is an early sign that it could be changing direction very soon, within a couple of weeks, potentially, or days. Now, on this position, we've been in this position since October 31st. We've got 0.98% profit in the trade right now. That would put us in a net position, short 50% in the SPY, 50% cash, with a 0.98 position since when we got short. Understand that these are, if you were to trade two separate accounts, you would be using these two separate allocations, still capturing profit from 6/10/2020 on this long position, and still short 75% with a net roughly 1% gain. Now, if you consolidate that down into one account and one position, you are short 50% SPY, 50% cash, and that gets us a net position of 50% with a 1% profit in the trade. Understand, ladies and gentlemen, that we're flagging out basing, getting ready to start a new upward momentum trend, and that could be very powerful. Now, I've gone through the charts, And the only thing I want to update for you is the mid cap has turned bullish. So understand the mid cap S&P 400 has turned bullish. This is very good, as well as consumer staples. I added consumer staples because I think it's important for you to understand in a time of consolidation and in any type of recession or early stage recovery, consumer staples will start to perform before other markets start to perform. So I believe this mid-cap 400 bullish trigger is a sign that buyers or traders are starting to pick up value in the mid-cap 400. They're starting to look for undervalued stocks, which are not going to be apparent in the ES, NQ, and the YM. So we're starting to see some real early signs of bullish bottoming and trending. The SPY is still bullish weekly, bearish daily, as I showed you before. Transports are bearish. ES is bullish weekly, bearish daily. NQ is bearish. YM is bearish. Gold is bearish. Silver is bearish. We're looking for these to change. And crude oil is still bearish daily, bullish weekly. Remember, I believe crude's going to move down to roughly 62 to 64 before we take off and try to find a bottom. Bonds are trying to hammer out a bottom, so they are still bearish. And I really am excited about this consumer staples move and the mid-cap 400 move, because I believe it's the early warning sign that we're building a momentum base where we could start to see some sort of an upward advancement, some sort of a melt up. Now, the end of the month, I will be updating this graph. This is where we were as of the end of October. So we are, again, flattening out. 2022 could end up being a fairly flat year. We're going to see how it plays out, see if we get any change. If we get a melt up here, we go 100% back into long position on the SPY. We could see this end up being like a -2, -3, -3.5% type of a year. But we're holding up with the rotational modeling system here very well. We haven't seen a massive drawdown. I read an article the other day about some people that were down 60, 65% this year trying to trade this thing aggressively. And remember, I was pulling everyone away from risk in August, September, October of 2021. And in October, November, I clearly stated that you should move 80 to 85% into cash. This is not going to last. Protect your longs, use your stops. And sure enough, we rolled over in 2022. We have stayed safely sidelined through most of 2022. And now we're looking to try to reallocate some capital potentially if we get the triggers. But right now we don't have the triggers, so we're staying safely protected. Now, I will say that we have same allocation levels. 10% stock, 65% cash, 25% metals. Metals are starting to do very well. And I highlighted that in the last video. I will show you back over here so you can be aware of it, that metals are starting to melt upward. This is my cycles indicator. I want you to pay attention to these lows. Remember these lows in 2018-19. Well, this is actually 2017-18. Then the lows here in 2013-14. Remember, these were early stage momentum moves before we started to see a pop in gold. We're getting that same basing level here. And if we take a look at the gold trend index, so I'll go back over here. Remember this basing area here in 2017-18 and then the early rally in 19 and 20? Well, look at this rally here in 19 and 20. That's the basing level. Here we have with the rally phase up to a peak into consolidation. We had a little bit of a rally here in 2022, which was, good in the gold trend index. But look back over here. Whoops, wrong direction. Look back over here in 2020, 2021, we had that same rally stalled out right here. So it's basically a basing pattern in 2021 and 2022 for gold. And where we're at with that now in 2021, 2022, we've got a basing pattern here. Now the next expansive phase is going to be like this. It's going to be a nice solid melt up which could be 2 or 3 or maybe even 400% over the next 4 or 5 years. But this is again where we're at with gold and silver and precious metals. It's very similar to 2004, 2005, in my opinion, where we're going to see the U.S. stock market move higher. We're going to see gold and silver and precious metals melt up. And then eventually around 2026, 2027, we're going to start to see a real parabolic move. Maybe 2028, it's in that range. 2026 to 2029, it's going to start to move parabolically, really skyrocketing. But historically, folks, I want you to understand this basing level moves into a next accumulation phase. So it's going to move into a big accumulation phase. Then it'll eventually peak out in a parabolic move, which will be back over here. Remember, it was 2011 when we had the parabolic move here. That's where gold, like I said, it'll rally up, it'll reach an apex, then it'll move into a parabolic phase where it'll start to come down here and start to really unwind. And then remember in 12, 13, 14, this is where we started getting the basing and the bottoming. This was accumulation. And that's what happens when we get into this accumulation. And then we get into distribution. So understand that we'll get into distribution as the parabolic phase happens, because a lot of people are going to be pulling out saying, I'll take my 400% profit, call it good. We get into distribution, then we get into accumulation. We're in early stage accumulation right now after going through a distribution pattern from roughly 2020 onward. This was distribution down into this area, 2021. Early 2021, we started getting into June, July accumulation. So now take a look at it here. We started getting into distribution. We started getting into early accumulation. Now we've gotten into accumulation. We had a bit of distribution going on over here, and now we're back into accumulation. Look at this over here. We got into a bit of distribution. We got into some early accumulation, and now we're back into this sideways accumulation. So it's coming, folks. It's getting there just like we want. Now, the real estate sector, oh boy, this is getting really interesting. Price levels are holding up. Inventory is starting to show more foreclosures. We're seeing a decrease in actual activity. Number of days on market is going up. Listings are going up. Market tightness is collapsing. In other words, it's becoming a very loose market. Sellers are aggressively trying to push out of these things. Foreclosures are going to start to increase. The markets are changing dramatically. You can see here active listing counts, the highest it's been in years. Reduction count is literally above 100%, so pretty much everything is being reduced. Days on market, this gray line is starting to inch higher. Prices, median share price year over year is inching downward towards the zero level, but it may turn negative. And like I said, it's just getting to be a very interesting market. Real pricing factor and real modeled market demand is collapsing week over week, keeps going negative. That's telling you that the market is very weak right now. Prices will eventually move into a negative year over year scenario. I hear a lot of people saying that, oh, well, prices may hold up. They may not collapse like we saw in 2008, 2009. I agree. We're not having a crisis event here, but that does not mean that we're going to not, meaning that does not mean we won't see minus 20, minus 25%, maybe minus 30, 40% in certain areas. High demand areas might only see a 10, 15, 20% collapse. Excessive bubble areas might see a 40, 45, 50% collapse from their all-time highs. So pay attention. We're just in the early stages of this unwinding yet. This data really, other than price reductions, inventory count, and year-over-year pricing moving down, as well as days on market, we haven't seen the big collapse yet. Okay, next we're going to come over here to the heat rank. So you can see the heat rank is flattening out near zero. This is telling us that, it's pretty much flatlining. We're not seeing prices collapse. We're not seeing them really rise. It's almost moving into a flatline scenario. The tightness ranking has collapsed to the lowest levels we've seen in 2.5 years. The real estate inventory strength has ticked up a little bit. This is off of this low. I expect it to move downward. And seller desperation has ticked up a little bit. We're not seeing an excessive move yet. What's really happening, ladies and gentlemen, in my modeling system here is that we've got this downward tightness ranking. This is meaning the market is underneath all the hype and the data and everything else. Think of it this way: it's getting very illiquid. Okay, sellers are not able to sell. They're not able to get buyers to come in. They're not able to attract buyers at rates and at prices where they're at. And I think I think we're getting ready for another downward price phase. Okay, and I think it's going to come in the form of a moderate waterfall event. So you can see here, heat rank was up 1.44%, nothing serious. Tightness was down 14.06% last week. That is a big drop, ladies and gentlemen. That means that the floor is falling away from the support levels for price. Inventory strength ticked up a little bit, and seller desperation ticked up a little bit, 1.70%. Now let me see if I can go to, nope, wrong one. Come back over here and try to go, nope, wrong one. This one, price levels, price reduction activity, real estate active listings change, and listing metrics counts. So price levels, as you can see, have flattened out, down near zero, okay? So this is why we're not seeing price levels drop. You are seeing reductions. Almost everything on the market is being reduced, but by maybe 3%, maybe 5%, nothing major, okay? So price trends will start to move downward. Active listing counts are moving higher. Reductions are moving higher. Here's your active listing counts. Here's your reductions. I believe this is going to start to accelerate considerably as weakness in the market perpetuates. And as you can see here, new listing count metrics, new listing count was up 45%. New listing count change was minus 0.47. Actually, that's where it's at right now. Sorry, that wasn't up. That's where it's out right now. So we're getting large amounts of new listings, new foreclosures. New count change is minus 0.47, and new share of market is 0.66. So these are accumulating. These are moving upward. The trends, we're at the highest listing count. The reductions are going up. Listings are actively higher. Price is flat. And like I was showing you back over here, hold on. I don't know what's going on there. All right, whatever. I'll show you later. New listing counts were, see if I can find it. Nope. All right, I'll find it later. Okay, so let me come back over here to my server and show you kind of what's going on. This is the XLP. This is the Consumer Staples Index. You can see on my rotational modeling system, it's moved bullish. Okay, this is very powerful in regards to a shift in consumer dynamics. And you can see here, consumer staples have continued to stay in bullish trend on the weekly chart. So that's very, very important. Next, I want to highlight over here the mid cap 400. You can see it is bullish here on the weekly chart, stayed bullish, and it has gone bullish over here on the daily chart. Big solid rotation. Now I want you to pay attention to these yellow diamonds. Okay, these yellow diamonds warn that we're nearing a critical inflection point, a potential top or a potential bottom. So understand that when we get into these yellow diamonds, this is where we could see things rotate like we had back right over here. Okay, this was a rotation that just changed direction because it crossed downward. This is warning us that, okay, we could be changing direction and or topping. This is warning us, okay, we're bearish, we could be changing direction and or bottoming. So understand that when we come over here and we take a look at the SPY, which is where we run our primary rotational modeling system, we are bullish on the weekly, bearish on the daily, but we had some of this yellow topping formation. We could very easily, on a sideways consolidation melt up, roll into topping formation and or roll bullish into a melt up formation going forward. And I think it's very, very important to understand that the transports could do the exact same thing. So the transports here are bearish, bearish. You can see bearish weekly, bearish daily. We're not seeing any rotation here. We could see this roll into a bullish trend. Same thing with the financial sector, XLF. We could see this rolling into a trend. You can see we had this warning here. This is daily, still bearish daily, bullish weekly, but we could roll into a very strong bullish trend here in just a matter of days. So it could be a very strong inflection point. We could be moving back into a bullish trend. Most importantly, ladies and gentlemen, we're seeing strength in the consumer sector. We're seeing strength in the mid-cap S&P 400 sector, and we may see the markets move into a melt-up bullish trend early Q1, Q2, 2023, kind of a bullish phase. So be prepared. This is a very dynamic market. I know there's a ton of doom and gloomers out there that think this is going to collapse. Something's going to happen. The rug's going to get pulled out. Yes, real estate's going to probably stay under pressure. Okay, but there's a ton of money in the market that's been pulled away. It's being redeployed right now in an early stage bottom. It doesn't mean real estate's going to go up. It doesn't mean that all assets are going to go up. I think this is going to be a selective base. I think technology, undervalued innovation stocks, alternative stocks like the ARK funds and possibly marijuana and others could move up. Gold and silver and metals likely are going to base and bottom and start to rally for 3+ years. But I think we could see a moderate base, momentum base setup over the next 3 to 6 months and move into kind of a moderate rally targeting potentially new all-time highs in the SPY and potentially targeting a 3 to 5 year kind of recovery phase to an ultimate peak. So pay attention. Everything is very dynamic right now, but we don't have any confirmation to be overly aggressive. We are still safely protected. We're still away from risk, and our hedge is in metals, which are performing very, very well right now. Bonds may shift, but they haven't shifted yet. Okay, guys, that's it for now. On to my next video. Follow me on YouTube, follow me on Twitter, tell your friends about MENT.com and what I do. I really appreciate it. I'm trying to keep you guys informed and learn how to profit from these bigger trends. Of course, and stay away from risk. Talk to you soon.